Hey, what's happening, options traders? Good morning, everyone. I wanted to bring up what's really an old topic that seems to be resurfacing these days for some reason or another, and that is a little calculation that options traders used to do called the percent to double. And it was a really big thing, and a lot of the brokerage platforms would always announce that, oh, we show you the percent to double, like it was some kind of big inside information that gave you the magic bullet for making money in the stock market and by using options. So, what is the percent to double, and why do you have to be careful in using it? Well, the percent to double is very simply a calculation from a pricing model. And what it shows is the percentage move in the stock that's required to double the options price. So, for instance, let's say that the stock is currently trading for $100. We put in an option pricing model and it says that this $100 call should be trading for 2. Now our broker's platform shows that the percent to double, let's say, is 3%. And what this means is that if the stock makes a 3% move right now, in other words, it moves from 100 to 103, that this $100 calls price will double and will move from 2 to 4. So for example, let's go over to a pricing model and see how it's done. So over at the OIC's website, this is optionseducation.org, let's assume that we have a stock trading for 100, the strike is 100, 30 days to expiration, 20% volatility, and 1% interest rates. We hit calculate and it tells us that the call should be trading for about $2.32. So the percent to double says, by what percentage move do I need to increase this stock price so that this becomes about 464, maybe 465? Well, it turns out that's going to be about 103.65. Puts us right at 465. So notice that the stock would have to move 3.65% in order for the options price to double. So on one hand, it seems like a useful calculation and fairly simple to do. So what are the problems with it? Well, problem number one is a big one, and it simply gives traders the wrong perception. And when traders hear about the percent to double, they assume that a smaller required move in the stock is better. And that would be true with all things being equal, but it just isn't. If you have a smaller percent to double, it's going to require a faster move in the stock, and it's quite simply just a riskier trade. So in a sense, it's like maybe when some traders say that they're better off owning a penny stock because they can own a large number of shares. Well, the number of shares that you own has nothing to do with your returns. Let's say a penny stock trading for $1 has a much more difficult time rising $1 because that's a 100% move in the stock. Whereas a $200 stock can easily move $1. But you see, that gets lost in the shuffle if you're just focusing on the number of shares that you're owning. And that's a little bit of what's happening here. When traders look at the percent to double, they just get too focused on the options that require a small move in the stock to double the options price, thinking that it's a safer trade, and it just isn't. All right, so what's problem number two? Well, the calculation is only good for the day. At a minimum, time's going to pass. So as time passes, that percent will change. Now on top of that, if the stock price and or volatility changes, that's also going to change the calculation. So if you happen to see this on a platform or if you're doing your own calculations, you have to understand that it's good only for that moment in time. So these are big problems, but again, they miss the point. The better thing to understand is about fair value, which I've talked about many times in previous videos. The fair value is what matters. And the percentage moves in the stock are all accounted for in the options price. That's really what it means to have a fair value. So whatever number the option pricing model spits out, that's all accounted for. So yes, in some cases, you might need only a 3% move in the stock to double your options price. And in other cases, you might need a 20% move in that stock price to double your options price. That doesn't mean it's a worse deal. The one that has the larger required percentage move has more time to expiration and/or more volatility. It's more likely to make that move. So all of those percentages that people are looking at with this percent to double are already accounted for. And so when they start putting it in this format of percent to double, again, they're looking at the wrong thing, and it leads to misperceptions, and that leads to bad decisions. So for anyone who might want to use the percent to double, what's a good solution? Well, an easy way to use it is to assume that 1 day remains to expiration, regardless of how much time actually remains on your option. Second, what you're going to do is to calculate 2 times the option's price. Whatever that initial option's price that the option model gave you, just double it. And whatever that value is, you're going to make that equal to the intrinsic value. And what that does is it shows you the percent needed to double, but more importantly, it's the maximum percentage needed to double. So it doesn't really matter what happens to volatility. If volatility drops to 0, if time drops to 0, we know all of that is gone at expiration anyway. So it's telling us the maximum. Now, obviously, if the stock makes a bigger move beforehand, or if volatility happens to increase during the life of the option, we might get a doubling of our option's price sooner. But at least this gives you the maximum boundary. So for example, let's go back over to the pricing model. So let's go back to the original example. Stock and strike at 100, 30 days to expiration, 20% volatility, 1% interest. And it shows us that the option's price right now is $232. Well, rather than trying to figure out the percentage increase the stock needs to move right now to double this option's price, I'm going to simply double it. I'm going to say this is $4 and let's call it 65 cents. So I'm going to put 1 day on the clock, and how can I get this option's price to be worth $4.65? Well, obviously that would have to be the intrinsic value. The stock price would need to be $104.65, and there it is. We've doubled our option's price. So it tells me I need a maximum of a 4.65% increase in the stock to double my option's price. So again, if it happens sooner, maybe with 15 days to expiration, we're going to get a doubling sooner. If volatility happens to increase during the life of the option, we will get a doubling sooner. But we know that in the worst case, if we go to 1 day to expiration, volatility is essentially 0 at this point, and doesn't matter what's happening to interest rates. We know for a fact we've doubled. So once again, for anybody who might be hearing about this calculation, it seems to be popping up a lot more. Be careful of it, because it's usually just a kind of a slick marketing way that people try to say we've got some secret information for you, or we're going to give you a list of options that have the smallest percents to double. And at a minimum, it's pretty much a meaningless calculation, and at a maximum, it's a dangerous one. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.